The sound you just heard was the quiet structural grounding of a global industrial giant. The US government, through its regulatory arms, has completed a move that aviation experts are already calling era-defining, not for what it allowed, but for the profound, unprecedented conditions it imposed on a critical expansion by Boeing. This was not a simple acquisition. It was a desperate move by the aerospace leader to bring its most problematic supplier, Spirit Aerosystems, back under corporate control to fix a broken supply chain and restore confidence. The government said yes, but with a complex set of constraints that have fundamentally rewritten the rules of American industrial power, transforming a commercial merger into a state-supervised reform. The deeper question beneath the headlines isn't about competition or antitrust, but about the economic concept of systemic risk in the age of global single-source manufacturing. The modern aviation supply chain operates on a psychological knife edge. Any failure in a single specialized node, like the production of the 737 fuselage, can cascade into a global crisis, compromising public trust. The government's decision acknowledges this reality. A private company's quality control failure has become an unmanageable public risk. The framing is shifting from a simple commercial contract to a matter of national critical infrastructure security. The surprising fact is the level of unintegration the US regulator mandated. While the acquisition was allowed to proceed for Boeing's commercial airframes, the defense arm of the acquired company was forced to be maintained as an independently managed subsidiary. Spirit Defense must operate with separate governance and reporting structures, creating a firewall between the commercial risk, the source of the recent crisis, and the geopolitical security risk. This historic parallel echoes the forced divestitures of massive industrial trusts in the early 20th century. For the regular traveler and worker, this matters because it impacts the fundamental economics of air travel, safety, and price stability. The government is attempting to structurally address the root cause of high-profile incidents, thereby lowering the perceived risk, which is a key factor in passenger confidence. Furthermore, a stable supply chain, secured by this restructuring, is essential for maintaining production rates, which prevents capacity shortages and soaring aircraft lease rates. This unprecedented regulatory intervention has stabilized one section of the American supply chain, but it has simultaneously set off alarms in every other global aerospace power. The US government's decision on Boeing is a public acknowledgement of a devastating truth. The 21st century model of hyper-optimized, globalized outsourcing for critical manufacturing has reached a point of catastrophic failure, forcing the state to intervene to reintegrate a key asset. The hidden mechanic targeted by this policy is sub-optimization through cost-center thinking. When Boeing spun off its operations into Spirit Aerosystems, the institutional psychology shifted from ultimate product quality to immediate component cost and schedule. This created an adversarial, rather than collaborative, relationship. The stakes defined by the regulatory action are nothing less than the reversal of this two-decade-long trend toward radical industrial fragmentation. The government is essentially mandating a cultural and operational shift back toward vertical accountability to mitigate risk. Here's the part nobody expected. The regulatory remedy did not only focus on the US supply chain, it directly influenced the strategy of Europe's Airbus. To secure approval from the competition watchdog, Boeing had to agree to divest key portions of Spirit's supply to Airbus. This means the US government's attempt to fix a domestic manufacturing issue paradoxically resulted in a forced redistribution of critical assets to its primary international competitor. This subtle geopolitical mechanism underscores the deep interdependence of the duopoly. This is fundamentally about institutional trust and the psychology of complex systems. The public, the airlines, and investors all operate on the psychological expectation of competence. When a system repeatedly fails, that trust erodes, leading to what sociologists call normalizing deviance. By forcing the reintegration and imposing long-term structural oversight, the US regulator is executing a pattern interrupt on this institutional psychology, sending an expensive, high-stakes signal intended to restore the public's faith in the engineering promise. The financial and operational consequences of this forced corporate surgery are massive, not just for the two companies, but for the balance of power in the global aerospace industry. The US government's move is being watched not just by Western allies, but by rising economic and technological powers as a template for how a nation defends its industrial leadership when a private champion falters. It reveals the silent rule of the new global economy. Strategic industry is never purely private. Other markets and countries view this decision through the lens of technological sovereignty and the national champion model. The US government's structural intervention, forcing reintegration and imposing long-term oversight, is seen as a tacit admission that the US is now adopting a more state-guided, European-style model for a critical industrial asset. This elevates the psychological perception of Boeing from a mere corporation to a strategic national instrument, much like Airbus is perceived in the EU. This competitive convergence of industrial policy is highly significant. The historical parallel that clarifies the true stakes is the Soviet-era space race, recast for the 21st century. Today, technological supremacy is measured by advanced manufacturing capacity and export dominance. The rise of China's state-backed COMAC and its C919 jet is the key pivot here. The US decision to stabilize Boeing's supply chain is a defensive geopolitical move, a direct acknowledgement that the West cannot afford for its champion to be hobbled by self-inflicted quality failures while a state-backed rival scales up. For the global economy, this decision illuminates a key insight from power structure theory: the fragility of the duopoly. When two companies, Boeing and Airbus, control 99% of the large commercial aircraft market, their health is synonymous with global stability. The regulatory pressure applied in the US is a global risk mitigation effort to ensure the entire world market is not vulnerable to a single point of failure. This action sends a clear signal to developing nations. The Western air travel system is actively being stabilized, which forces new players to prove they can meet a newly elevated, state-mandated quality standard. The greatest impact of the US mandate isn't on the boardroom balance sheet, but on the factory floor, fundamentally rewriting the contract between the aerospace engineer and the corporation. This is a mandatory multi-billion-dollar investment in human capital and process discipline. The mandate forces a profound organizational change, shifting capital from pure financial engineering back into production mastery. The company must now divert massive resources into two key areas: training programs and auditable, digital quality control systems. This creates an immediate surge in demand for workers who specialize in industrial automation, advanced metrology, and comprehensive quality assurance. The psychology of the workforce will change. Where shortcuts and deferred maintenance may have been rewarded, the new structure demands process fidelity and zero-defect manufacturing as the primary values. The part the media isn't discussing is the silent impact on supplier contracts throughout the global Tier 2 and Tier 3 ecosystems. Boeing's forced reintegration sets a new, brutally high floor for quality standards across the entire supply chain. Every other small and medium enterprise that sells a single component must now conform to the newly imposed, state-supervised levels of quality control and traceability. This will lead to widespread supplier consolidation, an economic pruning that makes the supply chain safer but less diverse, a classic trade-off between stability and competitive vibrancy. For families and workers in industrial regions, this means a shift in career stability and wage growth. The demand for higher-skilled, digitally fluent quality workers will push up wages in the aerospace manufacturing sector, but the consolidation of suppliers might increase the geographic concentration of risk. Behavioral economics suggests that this focus on visible, auditable process control is the only reliable way to break the corporate culture of complacency. It is a mandatory imposition of loss aversion on the system. The US government's decision to structurally intervene in its top industrial champion is the clearest signal yet that the era of completely hands-off strategic manufacturing is over. But while the world is focused on this corporate restructuring on the ground, The real transformation that will determine the next era of global transport and geopolitical competition is already unfolding quietly and in a place no one expects. The final critical push for sustainable aviation fuels and the global infrastructure needed to power them.